Wow, it's just nothing but heavy hitter panels, including one of maybe my favorites coming up here. These are some of the players in the industry that have been tokenizing and actively building for years, not just this year. I'm very excited to introduce for our on-chain treasury management, which is, as we like to kind of refer to as Yieldcoins. You heard your stablecoins. Well, Yieldcoins are going to give you some yield. We're going to talk about how corporate treasury and other applications are with Ryan Rugg, the global head of digital assets from Citi, Rick Golubov, the VP of digital assets, BD and partnership at Franklin Templeton. We have Meredith Hannon from WisdomTree, head of BD for the digital asset team, Prashant Kher from EY-Parthenon, and last but certainly not least, our moderator, Ben Weiss from Fortune. Come on up, y'all. Let's talk about Yieldcoins.
Hello, good afternoon. So as I was introduced, my name is Ben. I'm a reporter with Fortune, and we're here today with 4 great panelists who will talk to us about Yieldcoins. I think they've already been introed, so let's just get into it. So I think the big question, so we're sitting here right now, crypto's down bad, Bitcoin's down bad. And I'm curious, for you guys, you're all sitting from a much more institutional perspective. Is there going to be, does internal demand for these types of technologies kind of wax or wane depending on the market? I don't know. Rick, do you want to get us started? Or I said Rick, but but also Ryan too. Whoever.
Sure.
I answered both. So.
Well, it's great to be here. Rick Golubov from Franklin Templeton. I help grow our Benji suite ecosystem of our tokenized U.S. government money market fund complex, and really excited to be in front of everyone here. So if we look at the grand scheme of things, when we're in a unique spot, you mentioned, crypto's down bad. But I think that if you really think about our journey, when we started about 2017, 2018, thinking about digital assets, thinking about tokenization, rates were at 0. So we always look at this forward-looking, but you also have to look at it turning the clock back too, is that any time period, any time frame, if you have a vision, if you have an idea of what the future may look like, and if you're humble and you want to try to take risks, there's no better time than the present, and it doesn't matter if the market's up huge or if the market's down huge. As long as you have conviction and you happen to be at the right spot and have a company that has that vision along with your idea, anything can be accomplished. And whether dislocation or volatility is rampant, doesn't matter as long as you have the standpoint of sticking with it and understanding that you have the ability to kind of change a whole new market. So that's how we view the world.
Cool. Prashant, do you want to get into it?
Yeah, so I've been, and my name is Prashant Kher. I lead our digital asset strategy and M&A practice at EY. So I would say I started serving both traditional financial firms and digital natives, call it 2022-ish. And there was a time period where price of Bitcoin would go up, clients would ask their advisors would reach out to consulting partners saying, what is this, what do we do, talk more about it. I would say since, frankly, outcome of election November 24, the volatility of Bitcoin and the volatility of cryptocurrency hasn't really impacted the type of discussions we've been having with our clients. Banks, asset managers, wealth managers are realizing cryptocurrency is here to stay. There's utility with blockchain technology, with money movement, whether it's tokenized deposits, stablecoins, asset tokenization, different issues by the industry. And so everyone's really realizing they need to get ready for this on-chain future and really building forward. And so, yes, the price of Bitcoin does sometimes come up, but I've actually seen a much less correlation to price movement to activity with our clients, outreach from our clients, and desire to move forward with different capabilities and use cases.
Ryan, you were chomping at the bit. I'm curious because, Citibank is a huge corporation, right? You have people below you, people above you. Do you kind of feel the waxing and waning, kind of pushing and pull on your division and what you guys are doing, depending on the market conditions?
I think we've moved past just where like the crypto aspect of it to actually recognize it as a replumbing financial services from an infrastructure standpoint. So in regards to having lived through many crypto winters and hype cycles, like it's more about the underlying utility and being able to deliver 24/7, 365, always on liquidity, payment, and assets. So like the vision that I had a decade ago in this space, it's like the future of networks. Why does value, if it's fiat or if it's assets, not move at the speed of data on the internet? And really kind of bringing that together. So I would say, we stay course. Like these type of infrastructures are, massively, take a long time to implement and scale. So I think different hype cycles in the past, when I think blockchain, or you want to say, was a hammer looking for a nail, it's found its utility, right? It's found it's actually underlying what it's good at about, bringing disparate parties together to be able to move, instantaneously value.
And I think kind of pivoting a bit, right, to utility. I have to genuflect the name of this panel. It's Onchain Treasury, so we'll talk about that a little bit. Although there are other questions I have for you all. Meredith, I'm curious. Is WisdomTree using stablecoins to manage their internal treasury? Like, what are you seeing from your end?
Great question, and I'm Meredith Hannon. I lead business development for WisdomTree's digital assets, and like many of us, we've been in this space for over 5 years now, and I love Ryan's point around utility because it's a big one that we do too. So yes, for our own treasury, using our money market fund, but then our tokenized money market fund, but we are also, that same money market fund is also being used by outside treasuries. So we have third-party clients that are CFOs, they're treasurers of either crypto-native firms or traditional firms that have multiple businesses in different jurisdictions. So to Ryan's point around utility, it's also a cross-border payments opportunity. If you have a business in Brazil and you also have operations in Europe, how are you going to effectively move cash without having a bank account in Brazil, a bank account in Europe? You're going to have to wire the money between those two entities. Why not use a stablecoin? Or even better, why not use a money market fund where that's actually yielding? So we also have a partnership with StableC, which provides this on-chain treasury management for small to mid-sized businesses. So imagine you are a small construction company out of the Midwest and you need to pay a vendor in Argentina.
Is that actually happening?
Yes, that's live. That is live today, and it launched in
Who's
April.
the construction?
I'm sorry?
Who's the construction company?
So it is, I won't name their actual business name.
Sad.
Unfortunately, I can't. I'm sorry,
Sad.
but this is a real example. And maybe
How much
we'll
are
see.
they? Sorry, I mean it's always fun to
Okay.
find real life because we talk so much in abstraction.
Yes.
So it's like anytime I'm like, oh, there's a thing that people are using
Yes.
this complicated technology
This
for.
is live today.
Like how much money is flowing between this like contract? Like, are they significant flows or?
Sure. So it's in a pilot right now that it will be ending by the end of the month. We have tens of clients that are in it, so it's still small, but it's both they're using stable coins for these actual payments, and they're using our money market fund for actual yield-bearing treasury, but to the end client, so that construction company, that dry cleaner, that ice cream business, those are all real examples. They are just interacting in a Web2 interface that looks and feels like anything else they would do with online banking, but actually the plumbing and the assets behind the scenes are on blockchain rails. So what a powerful actual example for small to mid-sized businesses that maybe were debanked or they're not as banked as they should be to get competitive rates and be able to still put their treasury operations on chain.
So Meredith, you mentioned money market funds, right? But then there are also yield coins, deposit tokens, stable coins, right? Prashant, you're advising dozens, if not hundreds, of businesses through EY about what kind of potential form their stablecoin strategy should be. I mean, how do you see the difference? Because sometimes I'm like, as a reporter, I'm like, I don't know, man, it's all the same.
Yeah, I'm happy to break it down a few categories, and team, feel free to, or fellow panelists, feel free to jump in. See the broad range of on-chain money across a few different dimensions. There's stablecoins, privately issued, reserved back-to-back, one-to-one. Where we're seeing use cases there are cross-border payments, often P2P remittances, smaller value, from established markets to emerging market corridors. Deposit tokens and tokenized deposits, right? Ryan and team can speak much more in depth on that, but a lot of the big banks have launched tokenized deposits. These are tokens that exist on a blockchain that represent a liability on a bank's balance sheet to move money within the four walls of the bank, we're also seeing an emergence of consortia that are going to support movement of tokenized deposits and deposit tokens. And then to provide that on-chain yield, right, corporate treasurers don't want cash sitting there unproductive. They want cash, if it's sitting on-chain or off-chain, to be earning yield. In an on-chain world that's often swept into a Treasury money market fund, we're now seeing solutions like what Meredith and team are building out and Rugg and team are building out at Franklin to support that on-chain environment.
Here's the, again, putting on my reporter's hat, like, are we doing a game of semantics here where it's basically we say we have an asset, we have basically a USD pegged asset that's providing yield? Like, are there actual significant differences? Maybe I'll go to Ryan because, Prashant was mentioning deposit tokens, and that's something that Citi has talked about specifically doing. Talk to me a little bit about how you actually see those differences, whether there's actually differences in structure or whether it's a game of semantics.
Going back to my earlier point about the utility, like we support both. Like we don't think it's going to be a world of just one where, we've had, partnerships with Coinbase to be able to do pay-ins and payout in stables if and when our clients want to do it. We support numerous payment schemes globally. And so this is just another one, as well as building tokenized deposits that, as you rightly mentioned right now, it's internal only, but we're on a private permission version of Ethereum that if and when there's clarity and regulation around this space, we have aspirations of like not just having a Citi token, right? To make it a utility. Like our clients want multi-bank solutions. They don't want just a Citi token. And quite frankly, we wouldn't need to be on a blockchain if it was going to stay just internal at Citi. And we've recently integrated with our what's called 24/7 USD clearing, where we're a corresponding bank for 1,500 banks. Of those 1,500 banks, 300 are on 24/7 USD, meaning they can transact on a 24-hour basis, that we're integrating CTS into that. Because we do believe this has got to be a multi-bank solution. People don't want just a Citi token. If you think of large multinationals who we're focused on, they have hundreds, if not thousands of bank accounts across multiple banks. How do we bring that together so they have like one purview of their treasury and are able to move money instantaneously? So, in regards to like the stablecoin tokenized deposit, like debate, like we're going to support both, like if and when our clients want to use it.
In terms of your own internal treasury at Citi, are you already using some form of stablecoins or tokenized deposits to kind of go between Citi's different international entities?
So we work closely, the way that we structured Citi Token Service, like you gave kind of a little bit about the reserve management of stables versus, treasury. We have a liquidity pool with our treasury team. That's how we're able to create this 24/7 liquidity, off hours. So if it's, 4th of July in the US, but, you want to send money to Singapore to pay a supplier, typically you'd have to do it in advance of the holiday. Now you can do it on the holiday. There's no frictions or weekends and stuff like that. So yeah, we work closely with them.
Gotcha. Rick, do you want to kind of get in on here? Like, what do you think of this difference between all these 4 different categories? Do you find it meaningful?
Look, I think it all comes down to choice and what clients want, what the demand is, and how to make their world more efficient. That's the beauty of everything that we're all doing here up here, and a lot of folks in the room, is evolving into creating efficiencies, whether it's a deposit token, a stablecoin, or a tokenized U.S. government money market fund, that's a security. All these work in tandem and work together alongside each other to make it easier for our clients, whether they're retail or they're large institutions. All of these clients matter, and how we deliver that to them in a very easy, digestible way. As Meredith mentioned, they have some type of POC where it's behind the scenes and it looks like a Web2 app, but it's run on blockchain, right? I mean, that's ultimately how this is all going to work. Is you're really thinking about this and taking away the tokenization, taking away the crypto, just looking at it as it's a solution that's going to help me get from point A to point B, but it's going to be faster, quicker, and seamless. Like the beauty of what we're driving towards a future, as Ryan mentioned, the ability to pay a supplier in different jurisdictions. We have a utility called intraday yield. So you can send peer-to-peer Benjis tokens to other Benji wallet holders instantaneous, off hours, and person A can send to person B. It's 2:47 now. I can send those tokens to someone at 2 a.m. in the morning. I earn all that yield up until 2 a.m. in the morning. You can't really do that in a traditional kind of yield clock. We've been able to do that through the powers of blockchain and the powers of some magic inside at Franklin to be able to offer this. But it is a really efficient tool. If you really think about this superhighway that we've created, once institutions really understand the galvanization of around this and all coming together with all these like-minded institutions, intraday yield is extremely powerful concept. And you could move billions and earn millions very efficiently for 1 hour, 30 minutes, a day, 10 days, etc. That's the beauty of blockchain and having all these options in front of us through stablecoins, deposit tokens, tokenized securities, etc.
What about stablecoin rewards? Where do you guys stand on that? Because that
I'm going to let Prashant cover that one.
I mean, I know you guys probably have been instructed by, to not talk about politics, but we are talking about yield coins, right? So like, when I think of yield coins, I think of anything that's giving interest, cough, cough, stablecoin rewards, which is one of these hot topics, hot debates in Congress right now, vis-a-vis clarity. And I'm curious, how you guys are kind of thinking about it, whether you're closely paying attention to the debate because it's going to cut into the specific business models. I don't know, Prashant.
Look, I would say Genius Act put out clarification and guidance for stablecoin issuers. Issuers cannot pay yield. There was a variety of rationale behind that. There's obviously, if these tokens, which look like dollars, pay yield, and if you're a consumer, might you potentially move your assets to a different platform to earn that interest? And so there was two sides of the debate. One was, let the consumer decide what product, and the other one is the banking system exists. There's FDIC insurance, and there's guardrails, et cetera, and let people operate within the banking system. So Genius Act came out with language very specifically, issuers not allowing to pay yield. Clarity Act, which is working through right now, is going to provide further clarification. What was happening was the Genius Act was specific on the issuer, but not necessarily the distributor. So if platforms were distributing other stable coins, they were distributing yield in the form of marketing. And so Clarity Act has put some potential guidance around that to be determined what ends up in the final language. I think where we're going to see the world is where stable coins, at least Genius compliant stable coins, when they're at rest, they will not be producing yield. When they're in motion, potentially there's some sort of rewards. And if people want to earn yield in an asset, if they're making a payment, they'll sweep it from a stable coin or a tokenized deposit into a tokenized treasury and money market fund.
Yeah. No one else is. Oh, okay, Meredith, you want to wade into the hot topic?
I don't know if it's so much a hot topic. I think my question back would be, what is the end investor looking for? They're looking for yield. Why wouldn't you invest in a regulated money market fund that is bankruptcy remote, has no counterparty risk, you understand what the holdings are, it's a $1 minimum, there's continuous interest accrual, you can sell it 24/7, which are all features of what we have. So I think this is an education point too of know what you're buying, know what you're investing in. And I think also just broadly for WisdomTree, we have a suite of 15 tokenized funds that all launched in 2023 under the former regime, before Genius, before Clarity. So for us, this is really a moment to say, glad that everyone's come to the same party that we've been talking about for a while, probably for you all too. So looking forward to seeing what happens, if it happens. But I think the question really is for investors, do they understand what they're investing in, and why wouldn't you go something that is tried and trusted and true, and you actually get the yield, all of the yield?
How much of that education do you think is incumbent upon the distributors, right? Because like a lot of people are buying stablecoins from Coinbase or Kraken, or from Robinhood. I actually don't know. Can you buy stablecoins in Robinhood? Does it exist? Mm-hmm. Okay.
Yeah, they have a crypto arm, yeah.
Yeah. I mean, like how much? But they're not advertising, Franklin Templeton's Benji fund. They're not advertising. Do you think there needs to be actually more collaboration between these kind of retail on ramps and kind of what you guys are saying are the safer, more regulated options?
Personally, from our perspective, yes. A huge focus of ours this year has been distribution. So the example I gave before on the treasury management side for institutional, we also announced a partnership with MarketNode out of Singapore. So we are continuing to do distribution types of arrangements to get scale, and with that comes education. And a lot of that is formulaic based on the regulation. So I do think there's a lot more to come there.
I mean, Rick, what do you think? Do you wish Coinbase offered Benji? Can you hear me? In terms of offered the Benji token to all of its, users?
So it's not as simple as just offering tokenized securities and just, here you go, here's the security, run with it, put it on your platform. Benji's of 1940 Act, Rule 2A7 U.S. government money market fund, and it is a SEC registered security. So in a world that we have, traditional business at Franklin Templeton, you would need broker-dealers, right, to distribute your securities. In the tokenized world, we're on the cusp, potentially, hopefully, of allowing, broker-dealers to offer tokenized securities like Benji to their end clients. But it's also not as simple as, here's a tokenized security, go run with it, everything's good to go. The broker-dealer platforms also need wallets, right? So there needs to be this bridge that's occurring now, and that bridge is called stablecoins that are flowing more freely than they ever have been. So that's step one, right? Step two is more and more large institutions have wallet infrastructure initiatives in place where they're either building their own wallets or they're talking to our great partners in the ecosystem about bringing those wallets into their ecosystem. So all this stuff has been happening over the last 5 years, some sooner and some are really been picking up pace over the last couple of years. So I know I'm kind of long-winded in your question, but yeah, sure, yeah, of course. We'd love to. Look, at the end of the day, we're a token issuer. Franklin Templeton has been around almost 80 years. The reason why I'm standing here or sitting here with these great colleagues is that we've built a business around distribution mutual funds. That's how we've built our business, 1.7 trillion in AUM, right? We've done that. But we haven't done all that in the tokenized space because of certain regulatory gating positioning. And that's why we have 4 unique products that are available in different jurisdictions where we can move a little bit differently than we have been in the US. So all things revolve around clients, meeting them where they want to be, but also understanding the regulatory scope as it relates to securities at each geographic location.
I think that's a really good point about meeting clients where they are. We're up here talking about tokenized deposits, crypto, tokenized money market funds. Like, the reality of where most large enterprises are right now is they can't even handle real time, right? Take out the whole tokenized deposits, stablecoins, tokenized money market funds. We had a client that ended up moving money at 5 p.m. on Friday to Singapore, which was 5 a.m. And they're like, but the money's not in my end-of-day report. It's because your end-of-day report, runs at 6, 7 p.m. and you moved it after due to the time zone. But if you logged into your bank account, it's there. So the whole treasury management systems, a lot of these large enterprises are still batch settlement. They're still used to T+1. So migrating to a world that is real time, that has inter-day yield, is going to be change on both sides. And in part of our design, we obfuscate the complexity of a blockchain because recognizing a lot of our large clients don't have resources internally to, host nodes and manage wallets and manage keys. It's complex, right? And there's additional risks. You're going from batch settlement to a network that's on 24/7, 365. There's no downtime. There's no T+1, which means you have to set up different risk parameters around it. So I think that brings it in also. It's we're meeting our clients where they are. In our design in phase 1 where we are now, clients don't actually hold the tokens. We'll mint it in one branch in New York, we'll send it to Singapore, and we'll burn it. So it's cash for cash in their end-of-day reports, in their accounts, so they don't have to manage the complexity of the blockchain.
I mean, how much of this, we were talking about education, right? How much of this is will Citi or does Citi literally go, into a client's tech stack or financial stack and say here's how you're going to re-architect it to comply with our, so not comply, but make your system compatible with our deposit tokens or kind of 24/7 world that we live in.
I mean, from our side, it's fully compatible. It's a drop-down box that says Citi Token Service. They literally click it and they're able to use money just as they're able to choose ACH or Fed. Now, any type of payment scheme they're able to choose. So we completely obfuscate that complexity. On the treasury management side, I remember from, our days, SAP is doing some SAP digital, but the big players, they've implemented these treasury management systems over decades that are very bespoke. And I had a large treasurer come to me and say, even adding an additional currency, takeout token, can take months. So now add tokens into that aspect of it. So, the change will happen, but it's going to take time. And we talk about interoperability as an industry, and it's always about interoperability with, other blockchains, public, private, but the way that we think about it and the way that we're architecting it is that it's fully interoperable with our traditional systems. If they're in cash or they're in tokens, they're able to instantaneously move from one asset to a tokenized money market fund back to fiat. So fully interoperable in that way and backwards compatible also.
Yeah, I mean, Prashant, in terms of interfacing with clients, you're someone I think of as doing this probably on the daily. How much of this is because I think an interesting point you're making, the nuance you're adding, right, is it's technologically they don't have to change things, right? For these clients, if they're interfacing with the city, it's more about their processes, right, and how they're actually sweeping funds into different accounts, et cetera, et cetera. Prashant, how much of when you're working with clients that want to kind of implement an on-chain treasury management solution or kind of integrate tokenized deposits or stablecoins or what have you into their workflow, how much of it is actually the technological part of it, and how much of it is actually just changing procedures, kind of internal procedures for treasury management?
Yeah, I'll hit 2 points. So first one, actually, public knowledge, EY has been accepting stablecoin as payments for the past probably about 2.5 years, over 8 figures a month from clients like Coinbase, PayPal, and others. We had a bunch of clients in the digital asset space that wanted to pay us in stablecoin. It took us probably a year and a half to go through compliance and onboarding processes to get our internal treasury comfortable. We due diligence our custodian provider. We due diligence the networks, which is Ethereum. We due diligence the stablecoin issuers and stablecoins, USDC and PYUSD. We had to update processes, procedures. We had to define policies around how quickly we would off-ramp, all sorts of different considerations before our treasurer signed off. Then what we saw was it was quite a painful process. We had to send via email a wallet address, get the wallet, and then someone would take hours reconciling on the back end. And so that's where with SAP, there was they're building out a digital currency hub to support automation of APAR and invoicing, to support some of that automation to now allow the corporate treasurers to facilitate and make stablecoin payments. Last summer, we ran a survey of around 250 corporates, and frankly, the biggest pain point, corporates saw the benefits of blockchain payments. The biggest pain point was no one wanted to implement wallet technology themselves. They wanted either their banking provider, their treasury management service, their ERP. If it was integrated, they'd love to use it. But no corporate treasurer, which goes through every decade a new SAP implementation, is going to all of a sudden spin up a wallet to support some sort of transaction.
Do you know any corporate treasurers who are degens?
In the Web3 space, I suppose.
Yeah, Meredith, I'm curious, we're talking about, does WisdomTree work with, because you do have a treasury management system that, the solution that you're talking about, this construction company sending stuff to Argentina. I guess it's a question that's interesting to me because it's actually how much of working with the people is just actually working about procedures on the back end rather than the technology?
I think it's not just about procedures, though, too. I do think it's about understanding where clients are and what they need, and then also sometimes the technology is critically important, especially when it comes to security, safeguarding assets, understanding how wallets and keys are managed. All of that is absolutely paramount. But at the end of the day, it's also about what's the actual end investing experience and what benefit are clients or prospects getting from using these assets. So I do think it's twofold. I'd also say as well that something we haven't touched on is also this sense of beyond just the regulatory jurisdictional arena too, is also around KYC and identity. And I do think that that's something that's also critical here as well, because we are individually onboarding each of these entities, each of these businesses. And then when you start to think about scale, to my point before about distribution, that's why scaling on that end is so critical if we really want to get this to mass. So we don't use a whitelist, we use a soul-bound NFT that can create kind of a network of networks effects, but that's a big focus for us too, is saying, how do we think about identity in this new realm that is going to enable us to get to as many people and investors as possible while still being within the regulatory framework that both Rick and I sit within.
I mean, Ryan, that's, KYC is a huge thing, for banks, for Citi. And I think it's a big question with deposit tokens, right? Or any sort of token that's issued by Citi. Does Citi actually have to KYC each person this is transferred to? How are you guys thinking about that?
So currently all of our, users on, and we have gone to, now we, Last year we had a handful. Now we do have hundreds of clients on the platform, and we are processing billions. So we're starting to scale, but it's only KYC AML clients of Citi that are able to access this. But our clients don't even need to open a new account. It's part of like their master agreement when they open it. And again, just going with that, like we don't want to add additional operational. We don't want our clients to have to open new accounts. They have hundreds of thousands of accounts. If anything, most of our large corporates are trying to close accounts, right? They want to consolidate, they want to streamline their processes, they want to use technology to reduce costs, and like keeping in that theme and helping clients, it's like we don't want to add additional burden. Like accounts can take months to open, right? We want them to be able to automatically use the platform. And it is the benefit that right now we are within the four walls of Citi as we start to scale.
But what happens when you do scale?
And I think that's when we have to start looking at like how our regulators are going to opine on this, because there's a lot of questions still open around, you know, how many hops and who's going to be liable. So if like one of our large corporates, you know, took in a token that was using illicit behavior and then tries to deposit in the bank, you know, do we have to stop the transaction? Is the client, you know, held liable? Who is that? So I think we still need some clarity, no pun intended, and regulation out there around this space before, because we don't ask for forgiveness. We ask for permission. Like everything we do is a highly regulated institution, and like we take safety and soundness very serious. Like our clients entrust us with, you know, we move $5 trillion a day. So that's not going to change with this new set of rails.
Rick, do you want to go?
No, I was just going to say something funny. Didn't John Mayer have a song called Clarity?
Yeah, I know John
Maybe
Mayer.
he needs to be the spokesperson for
For
this.
GA.
Yeah.
How does it go? The song? No, I was just
We could do karaoke
I was just trying to get you to
later.
sing, Rick.
It's 5 o'clock. That's
Okay. No. I like jokes. More jokes, the better. Okay. The one question, like, I don't want to end on a bad note, so this is the second to last question. What do you think people are doing that's maybe stupid? Is the way of, you know, the gauche way of saying it, or maybe the more political way of saying that's not working within the Yieldcoin or like tokenized deposit space? And Prashant, I'll go to you just because you're, again, seeing so many data points on the day-to-day.
I think there's a lot of, and maybe for some institutions, fully building things themselves works, but we're seeing a lot of firms that are trying to build a lot on their own versus working with partners, working with ecosystems, and realizing that the way you're going to drive scale, the way you're going to drive distribution is by working with others. And so I think that's a big pain point that we're seeing, is really getting comfortable with how to work with, which is quite different from other parts of financial services, but getting very comfortable with working with others across the ecosystem or across the street.
Do some of those clients have fears of offloading some of that almost like risk
I think
onto other partners?
I think it's some of that, and some of also in traditional business models, typically these institutions may not work together because it's competition, versus there's a world where as these business models are shifting, perhaps you'll see new types of partnerships, new types of cooperation of similar type firms working together.
Meredith, what about you? What isn't working?
I think I'm going to go back to the utility point of, as we're asked a lot of advice, what should we be thinking about, what we shouldn't be thinking about. I think tokenizing for tokenizing's sake without a plan is an easy way to start to be building something that may not be fit for purpose or for need.
Who's doing that?
You know I'm not going to answer that. You've already tried this backstage. Stop it. But I do think that there's people out there who say, and I'll give an example from a few years ago. Someone had a Laguna Beach house and said, I'm going to tokenize it. Can't then someone buy a piece of it? And I said, well, unless there's a market for that. No. So I do think there's a little bit of, and we say that in jest, but I do think there's having a plan and understanding what it is. And I think there are a lot of different varieties and different types of these tokenized assets that are coming out, and understanding, again, what you're investing in, what your rights are, is very, very important.
Ryan or Rick, what do you think? What isn't working?
If you don't take a client-centric approach and you're just trying to like boil the ocean, you're not going to scale in this space. It's really tough. So like, you know, last year we were in what was called an early adopter phase, where, you know, we basically offered Citi Token Service free of charge to our clients to be able to start to, you know, move money instantaneous, weekends, holidays. Also, like, get feedback from clients. Like, that's why we added Euro in Q1. That's why we're adding additional to, you know, Asian branches in, you know, next quarter, because it's based on client demand. If it's not broken, what are you trying to fix, right? Like, make sure that there's a real use case before you go after this stuff. And I truly believe in, as I mentioned, like the ability to have atomic settlement and DVP and instantaneous movement of money and assets across the globe is a real benefit. But make sure that, like, you know, you understand that, because I've seen, and when I was at IBM, I see my fellow colleagues here, we advised a bunch of people in this space that just felt like they need to check the box. They just need to do something in digital assets or a blockchain to check the box for their board, not necessarily having a real pain point to solve.
One day, you guys will name names. Rick, what about you? What isn't working?
Well, I'll take the other side of what is working, and I think what's working is that.
Okay, we'll transition.
I'm gonna switch it up a little. What is working, and keeping it very simple, is that our colleagues on this panel, my colleagues on this panel, folks in the room, what we've done, the industry has taken a mutual fund, a traditional mutual fund. Let's remember that this is a traditional mutual fund, and we've tokenized it, digitized it, and put it on public blockchains. So that in itself is when we talk a lot about corporate treasurers on this panel and the future of how money movement, this is all being done with a traditional product. Right, and I don't think that often gets overlooked, that just because it's this tokenization layer that's on top of all it, that's what's working, is that we have products in this space that work. And the one thing that's not changing is people need yield. And most people in this country are not getting, you know, any yield on their, you know, most of their daily lives. So that's one thing that's not going away. So that's what I would just want to be really stressed, is that what's working is that tokenization is working, and the product landscape has worked, and it happened to be this great product called a money market fund that has turned into something entirely different. So that's what's exciting. I figured I'd, you know.
Yeah.
Positive.
Okay, we have about 25
Now
seconds.
Rick's gonna sing for all of
What
us
is
now.
working? Someone want to give like a quick answer to that to close off the panel?
I'd say there's been a shift over the past few years of folks in the industry asking, what is this and why should I care about it? And now it's more, what should I do, what should I focus on, and how do I do it, which has been quite exciting.
Cool. Okay, well, thank you guys so much for talking with me up on stage. And yeah, that's about it. And hope you guys enjoy the next panel.
Thank you.
Thank you.
Thank you.